Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. Roll time. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you get it next time. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Oh man, I didn't fix the camera here. Hold on. Okay, well, in the past 24 hours, inflation has become the hot topic, with JP Morgan coming out yesterday with a warning that the inflation reading of this morning could be hot, and the White House similarly saying that they are concerned. However, the White House has been sandbagging on these numbers quite a bit. They basically, every economic number that comes out, they're like, oh, we're super concerned. And then if it turns out to not be bad, it's like, the market rallies. So I would not put any of that as an indication that this number is actually going to be hot, but the risk calculus has essentially changed because of all this movement yesterday, meaning that if the number comes in line or under expectations, we could have a massive rally. So let's go and look at the damage, come over, look at all these markets. I've been messing around. I've been messing around with a KVM switch, and it's got all my stuff screwed up. Not that one. Not that one. That one. Ah, there we go. Wait, so then if I come over to this one, is that one correct? Okay, we're good. We're good. Okay, so the volume profile. So here you can see S&P 500 taking a huge dive and coming out of the range that they've been in most of the week. Treasuries actually not moving that much on it, but they did come down and they were pushing the weekly lows. Still quite a ways away from this 117.08 half, which is kind of where we're headed if things are really that bad. And then we've got oil. Oil continues to just chug along the upside here. Man, natural gas is all over the place. Gold and silver not looking so hot here this morning, and copper as well. So all the metals kind of a little sad. And cryptocurrencies still just going kind of sideways here. It's just not really doing anything all that interesting, which is kind of interesting. And then we've got the dollar. The dollar rising. This is the one. The dollar is the one that like always throws me for a loop. It's like, oh man, inflation, it's so bad. Oh, but then the dollar is the strongest it's ever been. What? That makes zero sense. But I mean, it kind of makes sense because the people are concerned about the markets falling out. And so what do? You go into chat. You go into cash. My gosh. Okay. I'm like, oh, okay. I got it. Yeah. Getting everything all set up here. Making sure I've got my, hang on. Okay. And I've got my, so I am not going to be trading this. I actually feel so much better today. I feel so much better today compared to what I've been. Oh my gosh. Did my, yep, I got an auto rollover. Okay, here we go. Let's fix that. So because I've been messing with everything, it kind of screwed up the whole workspace, right? There we go. There we go. Okay, workspace. Save.
1 minute remaining. Reading the US CPI month for month first.
All right, here we go. Yeah, anyways, I'm feeling really good this morning, but there's no way this is going to be such a massive move that I don't think I want to touch it unless I get like a really obvious sort of setup. So good morning, Nasdaq Killer here early. Good job, Lucas. Good morning. That's a pull, all right. Look at that in the 10-year. Good grief. Ooh, that must not be
1%,
very
1%.
good.
That's higher than the forecast of 0.7%. Canadian unemployment rate 5.1%, 5.1%. That's lower than the forecast of 5.2%.
Okay, core CPI month over month is spot 6 versus spot 5.
8K, that's higher than the forecast.
So it's not like
the US CPI year over year.
Ooh, man.
8.6%. That's higher than the forecast. 8.3%. US core CPI year over year 6%, 6%.
Okay, so the headline US CPI month over month was 1% versus spot 7. That includes oil and energy and all that sort of stuff. Core CPI was spot 6 versus spot 5, which is still above expectations, but not like crazy. But the degree of the move that they just had, like the knee-jerk reaction off of that, was insane. Absolutely batty. S&P 500 dropping well over 50 points just like that. Boom. Now I would be really cautious here. This is not something that I want to come in and like I'm gonna short it right at the bottom, because there's gonna be such a massive liquidity hole behind them that this could be very difficult turbulence to trade in. Let's come in here. I am going to distract myself by reading the report. Let's see if there is anything in the report that we can glean from this. It's crazy and people should be panicking and rioting. Oh, I don't know about that, Lucas, but it's not good. It's not good, but it's not a disaster yet. But you keep getting higher than expected prints month after month. Because like the whole thing is we're saying, oh, well, peak inflation might be behind us. And it would make sense for peak inflation to be behind us because a lot of the factors that were driving inflation, like the fiscal and monetary stimulus, are no longer there. And so, you know, that would kind of help a little bit. But what we're kind of starting to see now is that just like every teensy weensy little thing going on in the economy is supporting higher prices and more inflation. And so it's not going away. And that's a big problem. All right, so the report. I digress. The report. Consumer Price Index for all urban consumers increased 1% in May on a seasonally adjusted basis after rising 0.3% in April, the U.S. Bureau of Labor Statistics reported today. Over the last 12 months, all items index increased 8.6% before seasonal adjustment. So you still got like the vehicle numbers and everything kind of screwing things up, right? The index for all items less food and energy rose 0.6% in May, the same increase as in April. Okay, so see, that's where it's kind of like, okay, I really think that you kind of have to discount that headline number because of the oil and the cars and everything, right? The indexes for medical care, household furnishings, operations, recreation, and apparel also increased in May. The all items index increased 8.6% for the 12 months ending May, the largest 12-month increase since the period ending December 1981. The all items less food and energy rose 6% over the last 12 months. The energy index rose 34.6%, the largest 12-month increase since 2005. The food index increased 10% for the 12 months ending May, the first increase of 10% or more since the period ending March 1981. So we come in here April, May, and we got medical care services actually kind of decreased a little bit. Transportation services. Oh, no, wait, that's like year over year. Is that? No, April, May. Okay. So transportation services decreased a lot. Shelter was up spot 6, which is not good, but it's only a tiny bit. Medical care commodities increased a lot. Apparel increased a lot after having a decrease last period. Used cars and trucks, that's where it was like, okay, so we're having a decline in used cars and trucks, and now it's going back up again. But that one is like really messing up all the numbers, right? But then we come up to like food. Food was 1% last period, and now it's 1.4% this period. That's not good at all. And food away from home up 2.7 from spot 6 the period before. Okay, and we are getting this kind of vacuum sucking us back up after touching 117.16. Does that take us outside of the range? Oh, no, not quite yet. 117.08 half. My, oh my, oh my, oh my, oh my. So I don't know where you do it, but it seems to me that I could probably go long the 10-year. Seems to me that I could probably go long the 10-year. So let's come in here and see if what we got going on Twitter here.
Seeing here from FedWatch, US interest rates futures pricing about 215 basis points in cumulative Fed hikes in 2022. Fed funds of 2.985% at end.
Apparently you can play video games on Starlink. That's weird. And Michael J. Berry is going on about Clinton campaign corruption. That's hazardous to your health, man. Be careful, dude. I've said for many years, you need to learn how to lose in trading in order to win, but I still struggle with losses because I expect to win. In many ways, hating to lose is what's kept me in business. Use that competitive fire from your losses in a positive way. Make it a strength, says Anthony Grudelli. Curious. From the comments that he's been putting out, it's been difficult for him lately just because, S&P 500 has been falling. What news squawk is that? Well, the whole thing that I just read there about CPI was just the CPI report itself. Oh, wait, you can hear the news squawk. I'm sorry. That's the Financial Juice news squawk. Need to turn that off. Yeah. Okay. Oh, I need your help and support. Follow my new Telegram group. Nope. Ban. Yeah. Sorry, I didn't understand. Yeah, that's Financial Juice. A lifetime subscription to Financial Juice, one of the best decisions I ever made. At the time, I was kind of like, well, I mean, like I saved up all this money to do stuff with it, and would much rather like trade it or buy camera gear or something. But I was like, I don't know if we'll ever get an opportunity like this. I'm gonna go for it. I went for it. Best decision. One of the best decisions I made on this channel. No joke. It was it's really valuable having a good news squawk. And I'm not going to say that Financial Juice is the best news squawk, but it is pretty darn good. And it's definitely the most accessible to you and I. I really like News Squawk. If you got the money, go and get News Squawk. But hey, for the rest of us, Financial Juice gets the job done. And I have an affiliate link for it in the video description. Seriously, if you're going to be trading, you don't have a News Squawk, I would highly recommend you get a News Squawk. Yeah, there's an affiliate link in the video description. It should be in there. Should be down. Yep, it's like the third link. You got like the Jigsaw and Journalytics ones, and then you got Financial Juices after that. Yep. And then the mug. Because traders gonna trade. Yeah, I love the mug. I really want to make the shirt. But I need like a designer or something like that. Okay, so this is getting interesting. So I expected there to be, a retracement and all of that. I did think that, like, okay, it's bad that core CPI was higher than anticipated, but it's not the end of the world. In fact, one might argue that that was already priced in by the move yesterday. But to see this almost completely retrace that quickly is quite a surprise to me. Quite a surprise to me. And when I look at the 10-year, the volume is actually long. How is that possible? So there was a dip. They went from 50K to negative 55K or so, and now they're at negative 42. So there's actually been more net buying since the news in the 10-year treasury, which I find incredibly bizarre. But that could be because of a flattener coming through here. It must be. They must be selling the 2 and buying the 10 and 30 crazy hard, because that is just unreal volume. High divergence between products. Yeah, exactly. Like, look at the 30-year. The 30-year is substantially higher than it was before the news. We are getting a massive spread trade coming through here. This is ugly, ugly stuff. Oh, man. You see, this is exactly why I was like, even though I feel good, don't think that this is a move I should trade, man. Like, obviously, there's opportunity. I don't think I would have been one of the people reversing that and going long and seeing them bust the highs of the session so aggressively. Holy crap, right? No way. And how much would I have lost on that too? It would have been like 20, 30 bucks. I always feel good when I'm like, I shouldn't have taken a trade. And then the trade would have been an absolute dismal loser. I'm like, I'm doing the right thing. Doing the right thing. Got to be selective. We've got to be selective. Man, this is wild stuff. Well, it looks like that the treasury is going to back off for a little bit now. But oof. With the spread involved here, I kind of makes it difficult for me to know what to do. I think that the spread is so strong that we're really going to want to take the trade in like the 2 and the 5. But like, look at the spread in the 2. That's retarded. That's retarded. Bitcoin taking a hit off of this news, but then gold and silver also taking a really massive hit after already having quite a bit of a sell-off going into the news, and now bouncing and coming up to session highs. What? Like, what? I don't know if that one makes sense. I don't know. So if you come in and you say, okay, What's going on is we're getting a really massive flattener, and that's causing distortions all over the place. And that's why the move is contrary to what the news appears to be, that it was higher than expected. You'd be expecting everything to be falling. So if that is our base theory, and I'm not saying that it is, but if that is our base theory, probably the place that seems to be the biggest outlier because of all of this is gold. And I would want to be shorting gold, but I highly suspect that the fact that there was such a big move yesterday and the core CPI was only 0.1 above expectations, it may just be that the current market positioning and everything is what's really driving this. And so in that situation, it makes it a little bit difficult for me to predict the future orders, right? Like I would be sitting here and be saying, okay, well, I want to go short, right? But we're going to need to see something, a change in the volume, or maybe another headline or something like that that tells us that the next set of orders that we're going to see, this next leg, is going to be down, right? So I'm still I need to see something like really clear. And right now, what I see is a market that there's such big players getting involved here doing all sorts of stuff that you're going to see lots of moves that have absolutely no informational content behind them, or are contradictory, not in line, tricky, etc., etc., etc. So I don't want to be involved during that kind of action, right? I don't want to be involved. Forex Live, some quick short covering in stocks and the dollar giving it back. Yeah, and that's probably the biggest one also here, is that the dollar just shot up like crazy and they're giving almost all of their gains back. Well, here the treasuries are starting to push back down quite aggressively, so who knows? Maybe we'll see things move back down to the bottom again. Maybe we do get the trade that we wanted. But it's not a situation where I feel like I can take it. Shout out to Mohammed El Aran, who said yesterday it's way too early to say inflation has peaked. Can you imagine if this goes all the way? I know, right? This is I gotta tell you, for the treasuries themselves, this is one of the wildest things I have seen in a very, very long time. I'm going to remember this one. I'm going to remember this one for a while, right? Because this is a little zany. That they come out, the number was higher than expected. Everybody's panicking. And then the treasuries actually rally and a massive, massive flattener comes in. It's just, maybe that is like all kind of anticipated. Like if the S&P 500 is getting killed like that, like maybe, how do I say this? Like it could be the case that the high inflation has such an adverse impact on the economy that it starts to pull itself back, right? That maybe supply and demand are coming into play here, and that's going to be the thing that holds back inflation, and that the Federal Reserve doesn't actually have to be quite so aggressive, and that if the Federal Reserve was quite so aggressive, that it would be like a recession, right? 24-point opening range. So what do you do if you're one of them opening range traders? I don't know, man. This is a retail account killer move for sure, right? Mr. Top Step asks, what comes first, 20,000 Bitcoin or 40,000 Bitcoin? Oh, that's such a good one. Let's do a poll. You want a poll? I think so, because this is an interesting. What does Bitcoin see first? And then I'll say $40,000 $40K or $20K? Ask your community. The Fed doesn't have the tools to fight this. Well, so there's kind of is a curious. Here's the thing. There are definitely factors involved in the inflationary pressures here that the Federal Reserve doesn't necessarily have control over. Yes, that's true. But the thing is that when you get into that kind of a situation, the last thing that you want to do is allow the economy to keep revving, right? That's setting you up for real pain in the future, right? I actually think I was thinking about this yesterday. Okay, so here's a theory that I thought of yesterday, and maybe I'm probably not the first person to think about this, but consider this, okay? When you have a financial crisis, the problem, the thing that's holding the market back is confidence, and injecting liquidity into the system is really beneficial in that kind of a situation, because really what's holding people back is just like a crisis of confidence. So if you can get money flowing through the system again, you can recover very well by printing money and using the monetary tools that the Federal Reserve has. But it's not the same when you're having a recessionary pressure that was created by a natural disaster. When you have a natural disaster, like the pandemic, that causes a decrease in production all across the world, causes tons of layoffs, all of these sorts of things, that's like a fundamental hit to the economy, and you are going to see inflation. And injecting money into the system in that situation, yeah, you want to have easy monetary policy during that situation, et cetera, et cetera. But I'm wondering, you don't get as much out of it. You don't get as much out of the stimulus in that situation, because the cause is not monetary in that particular instance. The cause is a natural disaster. You get what I'm saying? And so when we look at the economy right now, the problem is not the virus anymore. That's past us. But there's all of these other problems that have popped up and or are knockoff effects from the pandemic. And it seems that the further along that we get, that every single one of them is inflationary. So much so that it's almost comical that a year ago we thought that it was just going to go away, right? Like it's getting to that point where my trade may have worked out, but I had to stick to my guns on my thesis. Otherwise, it took too much MA. Yeah, I hear you, Mr. Bond. It's like the problem that you run into in a situation like this is that you're a retail trader, and I only want to make or lose like $10 to $20 on a trade in the micros here, and all of a sudden it's like moving $50 a clip. Like, maybe you just shouldn't trade it. Maybe the volatility, I'm thinking in this situation that maybe the volatility is just too high for it to trade. Anyways, so does the Fed not have the tools to fight this? Well, I think that there may be something to, hey, the Federal Reserve can do all of these things. You're probably still going to see these inflationary pressures. That may be true. But the thing that I would disagree with is the people saying that means that the Federal Reserve shouldn't be raising interest rates, et cetera, et cetera, et cetera, right? Like if Lucas is right, that means that things are going to be bad no matter what, and the Federal Reserve should tighten monetary policy, and it will be bad for the economy, but it will be better than what the alternative is, right? And I think this is, so kind of tying that into what we were talking about yesterday, because I've been yelling on Twitter. I enjoy somebody was like, "Why are you yelling?" Because it's fun. I enjoy it. Okay, but there was a TikToker that was posting, and they were basically saying, "Oh, the Federal Reserve is raising interest rates because they want you all to be poor." Right. Well, their larger point, okay, that this particular creator's thing, issue, do whatever you want to call it. Okay, their pet issue is the Federal Reserve's natural rate of unemployment concept. So the Federal Reserve, they have this whole thing that there is a natural rate of unemployment, and once you get below that rate of unemployment, you aren't really doing any good by keeping interest rates low. And so at that point, the Federal Reserve needs to raise interest rates to keep things competitive, right? And this particular creator believes that's wrong. They think that if the Federal Reserve keeps interest rates low until unemployment is basically zero, which I don't know, like how low of a number do you want it to get to? I don't know. But they think that will put more people into the workforce, that they will be generating more stuff, and that will overall actually have like a reducing effect on inflation, et cetera, et cetera, et cetera. Right? Well, I do kind of wonder, is it worth making a policy decision based purely off of what the unemployment rate is? And I do think that the Fed is right on this, that there's a natural unemployment rate, right? But I also kind of think that it doesn't matter, because I don't think that you're ever in a situation where it's like, well, everything is terrible except for the rate of unemployment. And no, like, at least that's not the situation right now. Like, the situation right now is you've got to at least get back to neutral policy, or it's going to be bad, right? Like, really, we are 6 to 9 months behind. I understand why they're there. They made a mistake. They're going to make mistakes. Okay. But we're behind because of it. Problem is debt in relation to GDP. Well, that's another issue too, but like, I don't know if that's a problem you can solve. That's one that you put off and you put off until you really have to deal with it. And then when you really have to deal with it, everybody just says, okay, all debts are forgiven. Let's start from square one and hope it works out. So I don't know how else you get out of that hole, you know? Yeah, I think a lot of people foresaw that policy mistake. But I don't know, like, I have to say, you're kind of in a lose-lose situation, right? Like, if the Federal Reserve had started raising interest rates, or let's not say raising interest rates, because there's kind of 2 points that they could have done this at, right? Like, one was at the beginning of the summer and one was at the end of the summer. I said they should have done it at the end of the summer. Okay, so let's say that the Federal Reserve, they started tapering the balance sheet and raising interest rates like 3 months earlier than they did, right? Okay, so first of all, that might not have made enough of a difference, would it? I'm not sure. If they had done that, we would still be in a situation where inflation is high and interest rates are rising, and people are still concerned about it, right? So I think at that point, they would have been making the more correct choice, but they would still be paying for it, right? So then we got to go back to like May. So let's say they'd been raising interest rates all year. Well, I think you'd still be seeing some economic weakness, but maybe it would be milder, and maybe they get out of it, soft landing. Okay, so maybe they started doing it in May, right? Then we could have been okay, right? But think about like the political ramifications of that if they had done that at the time, because what the White House and everybody else would have been saying is, why are you tightening into another pandemic round, right? Like, it would have been very difficult to so like if you're the president of the Federal Reserve and one of your primary concerns is the overall health and public perception of the Federal Reserve, I don't know if making the actual correct play that we seem to think that they should have raised interest rates higher would have like placated people. You know what I mean? I think we're coming into a huge. Well, I think it already happened, Lucas. I like. I mean, if you're talking about a market regime change, I hope that when you say regime change, you're not talking about like overthrowing the president or anything like that. But over here, where was it? Where's my pen? Why I always hate it when the pen isn't open. Like I said it, I tweeted it out. I straight up tweeted it out. I made a TikTok about it and everything. Right here, when that happened, that was like something's changed. Something's changed. The market is all at once the bond market at least is all at once realizing that things are not so hot, and 3.5 to 3.75 would be your next target area. And that is exactly why I came over here and I put this short trade on, this swing trade short. And if this is really going to keep going, man, this is going to be like a 5 to 10K trade, right? Maybe it doesn't work out like that. Like again, core CPI, like here's the thing about this number. This is the most frustrating thing about the data that we've been getting, especially on CPI, is it will come into the number. Everybody's concerned about the number. There's a lot of eyes on it. It's like, this is like the biggest CPI ever. I think we could say, after how this has reacted here today, one of, if not the biggest CPI ever. But then what happens is the news comes out and it doesn't actually like resolve the problem, right? Like if this number had come out and core CPI, let's see here, we were what was it again? We were expecting spot 6. No, core CPI month over month. Yeah, we were expecting spot 5 and we got spot 6. What if instead we had gotten spot 8, right? What if we had gotten 0.8, right? Then it really would have been like, oh man, this is the Federal Reserve. Maybe they will have to do triple interest rate increases. They're going to have to raise interest rates well above neutral to calm this down. We're definitely going to cause a recession. All of these sorts of things, right? Whereas 0.1 over expectation is just enough to like make us all panic and be upset, but not really give us a super clear picture of what the next 6 months hold, doesn't it? Right? It basically what it does is it says next CPI reading could be even more important, right? Like the question never gets answered. It just keeps, oh, okay. Well, that's an interesting data point, but it doesn't really tell me what's going to happen next, you know? It's just like it never ends. And so we've just lived this whole year. This keeps happening on almost everything. So we've basically the past 6 months living in this wonderland of volatility and chaos. Okay, you're thinking more about like a Ray Dalio. Nah, I don't think so. Because here's the thing about a problem like that is that other countries have just as many problems, if not worse, right? And the United States having a problem with inflation is like really bad. Like again, the dollar moved up. The dollar moved up, right? When this happens and the dollar's collapsing and all of a sudden the dollar's at like 50, then I'll be concerned, right? But what I see happening right now is we let inflation get out of control. This is really bad. There's a very high risk of having a recession, but it's gonna suck, and it's gonna suck for everyone, not just the United States. And yeah, it sucks for China too, like because China like shut things down again, right? So that's a hammer on their economy. But not to mention that they got all of these other problems, right? So, well, I don't even think that we have. Okay, I'm not saying the CPI is the final nail in the coffin. I'm saying that like y'all going coffin shopping, but like nobody has died yet, right? like the whole allegory with the final nail in the coffin is like, okay, we think he's dead, but maybe we're in denial about it. So the person is in the coffin and we put the lid on and then we put nails. But when you put the final nail in, that's when it's finally like they're definitely dead because they're going into the ground anyways, sort of a thing, right? And I'm saying like that we don't have anybody in the coffin. This guy is still walking around. You know, he still seems like he's in good health. He's actually like lifting weights and looking stronger at the moment, right? At this exact moment. If there's some sort of this, I don't know. Here's the other problem, Lucas, is that the kind of prediction that you are trying to make is one that I think is strategically not a good one to make. I could probably have said that way more flowery. I think it always pays to be optimistic on the longer time frame. Right? Like my view on all of this, I don't know if we're going to have a recession, okay? It seems like that the probability of a recession is increasing, but that it's still not to the point where it's more likely than not that there's a recession. It's not a prediction, it's common sense. This is not common sense. Maybe we have a recession. It wouldn't surprise me if the world has a lost decade again, where, you know, we don't get to new highs in the S&P 500 for like 10 years. That could happen. I don't think that like we're going to have like a 50% decline in the S&P 500 or anything but like that. But, you know, 20, 30% declines, sure. And then like just sideways for like a really, really long time. And then it seems like we're making our way out of it. And then another, you know, panic or whatever. And this could go on for years, right? But then after that, if we have a last decade, then after that, crazy prosperity is ahead of us, guys. I got to tell you that it never pays. It has never. Okay. There's only one time in history that I can think of that making the prediction that society is going to collapse paid out. And that was the collapse of the Roman Empire. All right. Almost every other situation, it has always been to your benefit to be long-term bullish. Right. So I don't want to say it's like philosophically, but and there are reasons to be bullish here, guys. Right. Like, you look at financial history, okay? Like at the beginning of the century, we started to see the public become a lot more involved. This is when the stock market like really became a thing. Wasn't like everybody was investing in it back then, but you know, this is where that's kind of started. And then like we had the war in the Depression era, but at the end of that, not only did we have monetary policy, but we had kind of figured out like what is effective monetary policy. And then we moved over to fiat currencies, which I know a lot of people disagree with, but was a strong financial innovation that really allowed economies to grow and become larger, and also very much allowed the globalization that has happened, and that was very positive for the economy. And then we had the explosion of the information age, where all of this information has become interconnected and available to us on the internet, and all of the crazy things that have come with the internet, right? So when you think about all of those different innovations, those are all things that had very significant impacts on the economy, right? And here's what my prediction would be. the next 50 years of the innovation that you're going to see in the financial space and the economic prosperity that is going to result from it is going to be absolutely insane. It is going to blow your mind what the next 50 years entails. And y'all going to be around here to see it too. Okay. Because what's going to happen is we're going to start taking advantage of machine learning algorithms and agent based models that will elucidate many of the problems that have vexed us for centuries in the financial space and reveal optimal solutions to very complex problems. And the efficiency and prosperity that those kinds of that kind of knowledge is going to be nuts, right? And then on top of all of that, you're still going to see massive innovations in terms of like automation and material science and things like that. And so I think it is very likely that the price of a house, I mean, if you still want a house like the old style of a house, those are still going to be crazy expensive. But if you just need a place to live, there are going to be way cheaper houses. They're going to be automated built houses. They're going to be ridiculously cheap, like ridiculously cheap, right? It really is. There really is a big future ahead of us. And so, from my perspective, if we have a last decade, good. To me, good. As long as I still have a job, because I'm going to be putting up as much money as I can. And I can put a lot of money into the market in a decade, right? And then the decade after that is going to be crazy. I'm going to be happy, right? Doesn't pay to be pessimistic. Well, it's like saying the sun will eventually die. Well, okay. That one is a scientific certainty though, right? Houses are just stones. Well, the question is like what materials will they be made out of, right? Basically what will happen is there will be houses. They just won't be as nice, right? Like they might not be as big. They're not going to be made as nice of materials as you want, right? Like if you want a house with sheetrock and wood frames and so forth, and there's certain advantages that come with that. And there's going to be a lot of people that still want to do that. And the dream will be like, I live in this plastic thing, but I would really like to move into an old style house. I think that's what it's going to be like. This is exactly the situation when you're right, but you can still lose. Are you talking about the market in general here, Bond, or are you talking about the situation, the overall economic? Hey, good morning, Stephen. How are you doing? By the way, I've went on such a big long rant there that I've kind of lost track of where we're at. Okay, so we had a little bit of a bounce back up and now lower, not a breach of the lows, but ooh, the 10-year sold really hard on all of that. So the market seems to be suggesting to me that now that things have calmed down, maybe I could take a better spot. I think you would still have to put a decent amount of risk on, but maybe I could go long here on it going to 3.1. It seems like that would be a reasonable trade. I don't know. So I think that timing wise, we're in a good time. Is the thing. It's been 45 minutes since the news, so like that kind of makes current moment an interesting time to think about taking a trade, right? From like a volume perspective, that particular price is not necessarily the price, though. Well, I think it's probably still better for me to sit on my hands this week. Well, let's just make note of that 3.08, right? Or maybe, I don't know, like if I'm going to take a trade, I probably should do it here. What do you think? No, I don't know if I like that. So there is a little bit of a fight going on here. Let's just kind of chill out for a little bit. Okay, so there's 12 votes on our poll here. Whoa. All 12 of you think that Bitcoin will see 20K before it sees 40K? Is that for real? Or is it just not updating for me correctly? I'm shocked. 100% agreement here? Well, I guess we did just have like a bad inflation number, right? It's not going to be good for Bitcoin. Actually, for Bitcoin to be still at like what, 2,900 or so? 29,545 is like really it's quite surprising, isn't it? Okay, now 0.85. Well, maybe this one was the right thing. I didn't like that I was seeing a flurry of activity there. But like it's a pretty solid trend coming through in the treasuries, so I don't know. The S&P 500, like the treasuries bounced really hard. The S&P 500 did not. The S&P 500 did not. And the gold is getting hammered. So I think we're still like our call that like probably the move to make if you really think that this is going to go lower is to short gold, because that's the one that seems like the most out of whack. Looking like a good one so far. Okay, well, there was $10. Want to buy 3.9? I kind of do, but it might be just a tad bit too early for that. Let's see. Nope, missed it. I missed it. Nope, don't like that. I mean, it probably still goes for us a little bit, but yeah, now the volume's coming in. The 30-year is not to its lows yet, but this is gonna. So again, I think that like the downside target area is still like down at 0.8. So like I you know, of course this is like an insane trend and it's kind of hard to predict how far things will go, but I do see possibility for significantly lower. Are liquidity holes a function of price or time or something else? It's a function of the liquidity getting taken out too quickly. So I would say that it has to do like the thing that is most likely to create a liquidity hole is a lot of volume all at once. Right? That's all. You ever notice like when we're having a move and then well, maybe not even that we're having a move, but like maybe we're just in a range. But then all of a sudden like a huge order comes through, like all of the sudden 5K sells and you're like, oh, right. And a lot of people will be like, oh, I want to sell that. But I'm always like, ooh, because I know that it's probably going to go a little bit further, but then it's going to get snapped back and stuck to that because that creates the liquidity hole. Like the thing that's most likely to create a liquidity hole is a really big trader making a big mistake and having to bail a ton of volume all at one spot. That's what really screws things over. I am still using CQG data feed. Yeah, like a market order. Like if a 5K market order came through in one spot where it seems like it shouldn't happen, that can very, very likely to create a liquidity hole, right? Icebergs can kind of create them sometimes. But the basic gist of it is a bunch of market makers getting filled really quickly. Everybody that wants to trade all of a sudden being in a trade and there not being really any more volume to be able to come out. They get stuck. Okay, well, the 30-year dropped down there quite nicely, I must say. Not quite to a new low yet, though, and we are getting a little bit of a bounce. Any problems with the data? I mean, my thing is still, I just don't like it as much as Rhythmic. Is really what it comes down to. I just don't like it as much as Rhythmic. I really like the Rhythmic Trader Pro plugin mode thing is the biggest point. I really like being able to see multiple levels. I have had like occasional resets. I don't know if that's Rhythmic or if that's CQG or me or what, but I do get like these resets where like I only lose connection for like a split second, but it causes all of my DOMs to reload, which I hate. Right. So yeah, I kind of wish I was back on Rhythmic. But I wouldn't say that it's like problematic. And like the issue is like, especially if you want to do automated trading in NinjaTrader 8, then well, you're gonna have to use CQG, and it's like it's not so awful that I wouldn't do it, but it's just I prefer Rhythmic data. S&P 500 pushing lower. So I would say off of this whole, my own back and forth here at 08, I really should have taken that trade. A lot of it was the timing of it. It kind of seems to me though like that it's just been trending down since the top of the hour. So I'm not sure if that really actually had anything to do with it. That reset loss. Yeah, it really is annoying. So the liquidity hole is result, but results don't have any predictive power. Well, so NASDAQ killer, the thing that's so funny about a liquidity hole is that a liquidity hole does not necessarily give you a like I should enter into a trade here in this direction and it's going to go this way, right? Like that's what's so funny about it is that the liquidity hole is actually like, oh well, we're probably not going to go anywhere for a while. Right? Like the liquidity hole is like a really good reason to like hold back on taking on risk for a retail trader, at least. For a retail trader, at least. 5-year is pushing so hard, man. And the E-mini does not like it. Does not like it. Exactly. It tells you when not to trade. And like the thing is that if I'm in a trade and I see a really clear liquidity hole, I'm looking for a little bit of a pop and get out. Yeah. Like it's a really great place to get out. Because if I'm only looking for like one swing, then like that's it. You got the swing and you're done. And if you're looking for multiple swings, you just got to know that like once that happens, like you're likely to be sitting there for 45 minutes now, right? And I think that's one of the funny things is that I think that at least for me, and I'm sure that this happens to a lot of other retail traders too, is they kind of think in like 30-minute increments. So it's like, okay, we had a move, now it's been like 30 minutes, like maybe my next opportunity is here and so forth. And it's always like, and then you fail and then the move happens. It's like you're not waiting long enough, and it always seems like you wait too long or you don't wait long enough. But once you kind of understand what causes the liquidity hole, and basically, in order for us to continue moving, the liquidity hole has to heal, which means that you need to have enough time for enough market makers to accumulate in that area to actually have normal action again, essentially, right? Takes about 45 minutes on average in the treasuries, at least. But yeah, so like just watching this here in the 10-year, this is kind of doing one of those things where it's like where I would be in this position of like maybe it's worth taking a reversal here, but then it doesn't, it just keeps going, you know? Could you show a liquidity hole forming on a chart, or like can it only be seen in volume profiles? Oh yeah, you can absolutely see it on a chart. Because what you're gonna see in a chart is like this sort of a thing. So like if we come over here to the chart, so what it looks like in the treasury, like what I would look for is these sorts of things where it just goes sideways for a long time in like a 2-tick range, right? Those are very often caused by liquidity holes. I wish there was examples today. We could show you, probably we could go back to yesterday and see them, right? Okay, so there you go. So here's a good example. Strong move up, comes back, liquidity hole. And then look, they push beyond it and come back to the liquidity hole. And they push beyond it and they come back to the liquidity hole. Yeah, well, so what you see today, because the thing is we haven't really seen like a hole like the kind of hole that we're talking about. Because the other thing that will happen is I wouldn't call it a hole so much as there's just like this gap right here, right? See, everybody pulled, no volume went through here, right? So there are hardly any market makers here, right? Like that's the whole thing. Who is offering at these prices? There's not very many, like, because who thinks that it's actually going to come back up? And it takes time for people to come along and say, okay, actually, I think it might, come back, and I'll put it here and I'll put it here, right? It takes time. So the liquidity above us is really, really light, whereas the liquidity below us, those guys never got filled. So they're still there, right? So that's where you get these situations where it floats back. This is why almost every big piece of news with a strong gap has some degree of a pullback in it. It's really, really hard to tell like where it's going to happen and to play it, but it almost always happens because of the liquidity holes. Like this is an empirical, proven behavior that markets very consistently show. Yeah. Now, in this case, in the treasuries, I think there was something else going on. I think that there was like a spread trade. Because it coming all the way back up to here was a little crazy. just a little crazy. Okay, well, it looks like they're still going here. Man, so they are headed for this new yearly low with vengeance. With vengeance. There is some serious volume coming through here at 09 though. But that's could be a problem. I don't want to be too hasty, but that could be a problem. It would be a little weird for them. Well, actually, it wouldn't be a little weird. Like they could be that they stop just short of the 08 and then they have another pullback and they go for that later. I think that's a real possibility. The 30-year is just getting creamed here on this last move. Man. First movement in the right direction, second movement stop run. Well, I wouldn't call that second movement like a stop run, but it's kind of like a combination of liquidity hole and short covering, right? So here's another thing that I think is really interesting is that it seems to me, and this just is kind of an intuitive theory of mine, so I don't really have proof that this is actually the case. But it seems to me that a lot of really large institutions do not like to get involved immediately after the news. So it's very, very common for when you have really massive events like this one, or like some of those jobs events that are really far outside of expectations too, where you'll see the move and the pullback, and then you would think like, okay, like maybe the move for the day is done. And then 30-45 minutes later, the big institutions come in and they start doing their thing, and then it really, really goes, right? I've seen that happen so many times. It's definitely a thing. Oh, okay, so don't like that. I would love to see them just plow through that 08. So that is like a yearly low level. Like that really is something where could trigger a lot of orders, right? 08. But them acting the way that they are even before they're coming into it is not necessarily what we want to see, is it? Come on. Let's go. I'm surprised there's not like liquidity there at it either. It's probably not a good sign, is it? Like that's a level that you would expect there to be some large orders and some weird stuff there, and there isn't at all. It is it was 08.5, so we've ticked one tick below the yearly low. But it is a new yearly low. Oh, that is a strong offer, dude. Oh, man. Ugh. Okay, so what we're seeing right now, I think, is that there was a little bit of a hole, kind of like here at 09 when I was saying this could be a problem, but there's still really strong selling, so they were able to push through the hole. Okay, but we just if we're in a trade, we just got to remember like that there is some possibility of like pullbacks here still. So if we're not in a position or we're adding to a position, we do want to be a little bit careful about where we put it on, because there could still be like 10, 20, 1 to 2 basis point pullbacks. Yeah, that is new yearly lows. I have to say though, it was not. I mean, it was a pretty aggressive push down, but it wasn't like a cascade of volume or anything like that. Not yet. Is this going to 3.5? Well, probably not today, but it really kind of makes you wonder how far it could get today, doesn't it? But I really think that if I'm swing trading this, that yeah, like 3.5 is probably my target. Like this thing here in the treasury, I think I'm holding that until 3.5. Like I've taken enough sequential profits on it and everything that if it comes back to my entry, like fine. I think I can take that risk and let it run. Now here on the scalp though, we want to call it. I don't think we should really call it a scalp, but the short term trade. I'm not really getting paid too much here in the 10-year, am I? Oh, S&P 500 still very unhappy. We're almost approaching down 100 points now. Yeah, well. Darn. No, I'm not liking that at all. Don't think I want to offer down, though. But it is kind of looking okay. So I got my fill. I'm okay with it. I'm a little bit too concerned now about this note that we've formed at 09. So where did I get out at? Where's my Oh, there it is. 112. Okay. I was kind of thinking of getting out at the three, but was not. I was still thinking like, oh, like we could break new lows. But we could still break new lows, but the liquidity hole at 09.5 kind of suggests to me that like, okay, remember I see a liquidity hole, I'm looking for a little spike further, and then I'm out, right? Like I was a little late on that one, right? So who is the other guy that trades the contract you just traded? What do you mean? Are you asking me to theorize about who the other market participants are in this, or is there like some person that I should know that's also trading micro treasury yield futures? A little thin. I assume that who I traded against there was just another market maker, but a robot, but could be wrong. Okay, well, hey, it's not like amazing. $20 is nice. Oh, you were joking. Oh, okay. You see, if I had not gotten out of that, well, I got in at 3.094, so I would be giving up a lot here, though, right? I'd be basically at only plus 10 now. I really wish that I didn't 08 half. Then I would have made $40, right? Should have done it. I think like in that one, me not taking it, I mean, a lot of it was the indecision about I haven't taken a trade all week. Do I really want to start taking one now? And me thinking they might give me a little bit more time to do it, but I really should have just been, okay, let's do it. Was a little too shy. It's okay. Okay. Well, it come back and now it's back down here. So this whole area, oh, this is difficult. I have to say, like emotionally, I'm finding this difficult because here I'm seeing like this range right here, but then it's like, yeah, but it could go, you know? Okay. So my new squawk is pointing out to me that the probabilities of a 75 basis point hike, that there are people starting to price that in to the July and further meetings. So that makes a lot of sense. See, I want to just FOMO so bad in here. Maybe I shouldn't have gotten out. I don't know. I don't know. I don't think I should feel too bad about taking what I did in this situation that I did, but today is kind of like an unusual situation, right? So it could do all sorts of crazy things. Like, I traded the way that I usually trade, but I don't know. This is the one where it's like it just keeps going and going and going, and I'm like, why didn't I hold it? But then if I do hold it, it doesn't go, Yeah, it looks like it's gonna go. I don't know, there's a lot of volume both ways, but it's like the S&P 500 having a little bit of a pullback, so the whole timing of all this is a little interesting. I would hope that the Axia guys are making bank today, but they, for all you know, that they were the wrong direction. It's a good move. That's another $10. And it's kind of reloading, like they're gonna keep going. My recollection is that the difference in costs between the Rhythmic and the CQG was negligible. Oh yeah. Well, there is at least one guy over there at Axia that really does good at trading the news. And he's probably their most profitable trader, is my understanding. And he basically, like, most of the days, he just kind of does market making sort of a thing. And then when you get news like this, he just makes bank. Okay, so that was a good move further. I think there's still a risk of pullbacks back to 09. It was really like 25,000 contracts. That's a lot. This is a difficult situation because this really is kind of like a day in a situation where you could get a trend day in the treasury, right? In fact, I think it's likely that we get a trend day in the treasury. Is just that's like one kind of stopping point that can kind of hold us back for a while. So I don't know if that further move makes me like really anxious to market into things, right? Like a bunch of retail traders were really buying that and are stuck. And we bailed. They bailed. I think that was somebody they bailed because they got sweeps coming back the other way now. Hmm. So something I'm finding really curious here is that it does seem to be moving quite fluidly. Like, it'll go up 8 ticks and it'll go down 8 ticks. I'm not going to say that like the volume is too light, but because there are points at which there's a lot of volume, but it's just like it's moving really easily, and I'm not really seeing the correlations play through it either. So it's not really helpful from a technical perspective. Oh, okay, hold on, I'll be right back. Anyways, I don't know. I'm having an emotional moment here. Her grandparents just left too. That's sad to see them go. There's a big order there. Well, and there's that one at 057 in the 5-year is really like, whoa, okay. The S&P 500 kind of looks like they're staging a rally here. Oh, I don't know about that one. Did you reach out to IFR? Oh, that is International Financing Review, right? I did not. I kind of assumed that it was beyond my pay grade. Plus, I only wanted to read like that one story. Yeah. You did? And what happened? Did you get it? Is it good? Should I get it? Oh, you haven't heard back. you might hear back from. Who knows? Who knows? They have a Twitter account. You can follow them on Twitter, and you can at least see like the new headlines that they post. I don't know. Like here's the thing. It seemed to me like in that one situation, like they were the one outlet that would have had the piece of information that you wanted. But what they mostly post sounds like information that you would only be interested in if you were actually working at a bank, right? Well, I'm not quite sure what to make of that one. I'm a little weary about how much lower it can go. Like, I see the possibility that it could happen, but I don't see the thing that makes me think that it's likely to happen. When we did it before, I was like, well, they're going to break a new yearly low. So I think that they're going to go to 08. And so that's why that one worked out. Now that they've gone through 08 and they're kind of like having pullbacks from that area, like I'm really unsure. They could go. The other issue is picking a spot, because if you take it right here, like the chances of it coming all the way back to like 3.115 are a little too high. In other words, you're not necessarily getting the best price. They will probably only make it available to Refinitiv. That might be the case too. I'm just surprised that there's not like somebody out on Twitter talking about this. Actually, no, I'm not surprised. Like the issue, the issue that we have, Mr. Bond, and it keeps coming up over and over and over again, is that the people that really know what's going on aren't allowed to talk to us. You know, like I'm sure I wouldn't even be surprised if they're like listening to this stream right now. Like there's somebody over at Goldman Sachs. They love listening to our stream while they trade, but of course they can't actually post anything because that would be against firm policy. And they're sitting here shaking their head. Yeah, that's right, Seth. I would love to chat, but we're not allowed to. And they would love to be, posting on Twitter and teaching us the key things that we should be looking at and news to know and so forth. But they're just not. You're not allowed to use Twitter. If you are out there and you're listening to me, go add me on LinkedIn. I have some links in the profile, or sorry, in the video description. I have some links to LinkedIn. Go add me there. We'll chat, but don't tell me anything you can't tell. But I would love to just be friends. At some point it'll be useful. Okay, so back to 09 again. You know what's really going on here is I really do have the edge. And I really do understand what the volume is doing. And the liquidity hole is definitely there at 09 and is causing problems. And for some bizarre reason, I'm just not confident in myself when I should be. That's what's really going on here, isn't it? Banks just execute orders. They don't know why things are the way they are. Well, nothing says, well. So when you are, my recollection from when I was at Goldman Sachs, when you're at work, you can't post anything from firm systems. So the main concern that they have there is that you're going to like break a brick wall or something like that. Like this separation between the investment, the research side and the trade execution side, right? They have to keep those separate. So that's the first thing. When you're at home, you can use social media. Like you're allowed to have a Twitter and a Facebook and all of these sorts of things, right? But you can't say certain things, right? Like you would get in trouble if you had a Twitter account that was all about talking about trading and commenting on trading in the markets, right? Jan Hadzius is basically the only guy that's allowed to comment on the economy. So, but that's why I say, like, if you're looking to find the professionals, like LinkedIn is the best place to go. And they're not going to give you trading strategies, of course, because that's the firm's not going to allow them to. But what they will share and what you do see is public information that's already out there, and professional publications and things like that can be very, very valuable to you. I've learned a lot about machine learning from that kind of stuff. So, yeah. Orders are executed in the bond market all the time that could be unrelated to the economy. Yeah, that's true. Well, I mean, this is kind of a weird situation. Well, not a weird situation, but that is what makes this kind of a situation so difficult, right? Is that we did have a really, really critical piece of informative content come out, and the markets very much moved in line with that piece of informative content, but you still have these other flows that kind of make it difficult, right? I'm okay with it going now. I've that thing I said earlier about, well, I do know what's going on and I just need to be more confident about it. Like that was really me reconciling that I took my trade the way that I'm supposed to take my trade, and if it goes further, there's nothing that I can do at the moment to really be catching that. Do you know any cases where hedge funds have been hacked or spied? I can't recall of any kind of news story or anything like that. I'm sure there would be a thing that happened. But I mean, you didn't even have to take it that far, Sebastian. There is a whole field of study out there right now. It's really quite an exciting field of study about using alternative data sources. Any kind of piece of information that you can find out there that might be predictive of certain things going on in the market. Um, it's really cool. It's really cool stuff. Yeah, I don't know. Like, I do still feel they could make new lows, but I'm not getting a good spot. And I don't think that the new lows that there's that much in it. You know, like maybe we see 3.15. Maybe we that would be like the kind of reaching at the moment, right? So we can kind of I can kind of relax. They did trade a lot there at '06 too. So now if we've got two nodes going on here, that could also be a weird, could also cause some weird behavior. Another possibility that we got here, well, it actually is still fairly early on in the session, and we do get sentiment numbers. It's also Friday. I totally forgot that it's Friday. So, if you're a big fund, do you want to put a huge position on Friday? I don't know. Still kind of seems to me that this is not a situation I want to take a trade. This one right here, so like 715 was good. That was a leg for sure. So now another 45 minutes, that would put us at 8 o'clock. But I actually think that could be more like from 7:16 to 7:31, so that's 15. 30, okay. So it is possible that here in this window, we could see another meta order sell come in. Just remember that if it does happen, that those legs are probably not going to go as far because the liquidity becomes more and more strained. That's why it goes like this, right? This could be like the low of the day, but like we're maybe like right here, right? Like we caught this bit. We're maybe like right here. Do you want to, because it could come up and do this before it does that, right? So that's a lot of excursion. Especially after a great inflation number, some may think. Wait, why are you? How are you calling that a great inflation number? I understand what you're saying. Poor choice of words. Some may think that at one point today that all the sellers are in and start buying. Well, I see the case that you're making, and I will admit that it's a possibility, but I think it's unlikely. I think that what you're more likely to see today is in the S&P 500 in particular, they try and sell it all day. I think that they're going to try and sell it all day. There could be some aggressive short covering at the end of the day, right? But the kind of scenario that you're thinking about could be possible next week, though. Right? Like you could see something where it's like, well, actually, oh man. So next week is kind of an interesting scenario too, because you got options expiration in the Federal Reserve. So I'm probably getting ahead of myself with that scenario, aren't I? I don't know, but I do see this thing where it's kind of like, yeah, you might see some really aggressive short covering rallies still. Like I really think that right now. Let me come over here. Okay. Just need the S&P. It's really hard to not look at this. Maybe we look at it on a daily chart would probably be even better, right? It's pretty hard to look at this and not say, hey, that's a bear market rally, right? So it's really hard to not look at that right there and say that's a bear market rally, right? But what I'm saying is don't be surprised if it doesn't do this. Okay, a little bit lower, another bear market rally, another, don't be surprised. Also, don't be surprised if it's like this. Maybe we do go lower here, back up, maybe lower, but then ultimately up, like that sort of a thing could happen too. Okay, here's the news, the sentiment numbers. So it is quite a bit lower than the forecast. The treasuries are selling on that initially, which I don't think really makes sense. But what about the inflation expectations? 1 year inflation preliminary expectation 5.3, actual 5.4. So I'm not getting anything too useful out of that one on inflation. The sentiment is definitely not good, but the sentiment number kind of suggests treasuries buy. That the sentiment number kind of suggests the Federal Reserve can't really hike that aggressively, but they are moving still. So, wow, the S&P 500 did not react very well to that, did they? Come back over here. It does look like the dollar, like the flight to safety in the dollar is there. Where else are you gonna go? Everything else is down. What is there? Yep, I do not see a single thing. Oh no, wait. Actually, the 10-year is 10-year yield, but that doesn't count. I don't really see a single thing that's up today, except for the dollar. It is a sell all of the things event. Well, it's kind of screaming at me to sell it again. I don't. Zero Hedge is predicting a crash now. I don't know. So something that I find really curious about this market is that, like, on the short term, they continually overreact. You notice that? Like the degree to which a move will go is like further than it should be, and it will come back. But then several days later, some other shoe will drop, and then it will be like, oh, actually, the original thing was correct. You know what I mean? So it's like they're reading into the short term impact of the news and the information. They're overreacting, but they're underreacting on a longer term basis. So I'm kind of coming along here with this whole, like, I'm not too sure how anxious I should really be to sell the treasury here. The byproduct of reduced liquidity for sure. Well, this is just another example of market's not informationally efficient, right? There you go. I am rich in them. Oh, show me. How much did you make on it? Did you just sell and you just been sold this whole time? Please tell me yes. That would be so awesome. If you came in and you just made 150 point short. No, it's 100. If you made 100 point short in ES, that's my thing. Let's put it that way. love to see that. That 30 is kind of looking a little aggressive. So I got out at 1.21. Yeah, I should have held it. It's okay. I don't think that it was worth waiting. We've been in 45 minutes, right? I don't think that it was worth waiting, but you can tell how much mental torment getting out caused me, right? Because it's like, well, I saw the liquidity hole. I see the pullback and everything. I should get out unless I'm really going to try and hold it for the trend day. And I'm not so sure that I want to do that on a Friday. Okay, so there was a short push higher. Sorry, a short push lower, but then they're coming back to the 06 area. So there is still pretty massive hole here that's sucking them back up. Michigan U.S. Consumer Sentiment Index sinks to a record low. This is the lowest it's been since what, 1980? I think he just said. Oh, you made some mistakes along the way. Let's see. 10,000. Hey. That number is green, right? I can't. Listen, I'm not like super colorblind, but like when it's teeny tiny text, it's a little hard for me to tell if it's green or red, okay? Maddie Greenspan, Bitcoin not enjoying that inflation data. I'm old enough to remember when everyone thought Bitcoin was an inflation hedge, right? Oh man. Let's just wait it out. Like, here's the thing, okay? Anytime that you see Bitcoin dropping into the weekend, I would be on alert for Bitcoin, right? Because some of the worst moves happen over the weekend. I think that when that happens, a lot of it is manipulation. And I think that what's going on in the Bitcoin market isn't manipulation so much. But I would still be careful, right? Like there is this possibility. I don't think it's the worst consumer confidence ever, but it's pretty dismal. It's not a good sign. I don't know. So the issue that I have with the consumer confidence number here is that I'm not 100% sure what it means for us in the bonds. It's definitely bad for the S&P 500, right? I'm not sure how much drawdown it took me to get there, though. Right? I feel you, NASDAQ. Yeah. No. So like, I'm not sure that like I just want to go long treasuries on expectation that they go to 3.15 or something like that. I'm not sure I can say that. I think that this swing trade, keep it, but Nassim Taleb, note that it is when markets go south that many are forced to sell. Yeah. So here's something that I kind of learned the other day that, well, I think we kind of knew, but I don't think that we knew it like quite on this much detail. But if you are a market maker and you're like market making stocks, right? There's all of these wash trading rules, which really suck because if you really run afoul of the wash trading rules, you can literally end up like owing more in taxes than what you actually made from your trading activities, right? So what do? Is it just like screwed and nobody can do market making? No. Actually, there is a way around it. It's just that you have to specify that you're going to do that on last year's taxes. You can opt to do mark-to-market accounting, essentially, and then you pay your taxes on all of your mark-to-market, profits and losses. All of your income will be blah, blah, blah. New Squawk is talking in my ear, so I kind of losing my voice there. All of your taxes, all of your gains will be taxed at the regular rate instead of the capital gains rate. So you're paying a lot more in taxes. It's like 10% more or something like that, right? But that allows you to get around it. But there's another downside to it, which is really, really critical, and that is that you have to pay taxes on all of your mark-to-market gains or losses, which means that if you're in like Tesla or whatever and you've made $1,000, you have to pay the $200 or whatever it is, $300 in taxes on that, regardless of whether you've actually taken the profit in that instrument, right? So this is why you get these sorts of things where they're saying that for tax reasons and so forth, people have to sell at the end of the year and stuff. That's why, right? And now I'm kind of thinking here, does that create certain problems when you're taking losses? I don't think so. Probably it's the case what Nassim Taleb is talking about has much more to do with, I don't know. I think it has much more to do with like margin and so forth unwinding on you. Dude, I'm just are you saying that like you only now just looked at the equities chart? Dude, yesterday there was this guy, and I forget who it was, but they said if the tomorrow's CPI report is higher than expected, just don't look at the stock market tomorrow. Just check out. Don't come back for like a month. This is so true, right? And then the other one. Oh my God! Wait, let me see if I can. No, I don't need to find it. There was this one on Wall Street Bets that I thought was so effing hilarious. Oh my God! Yes, it's a true sharp scuff right after. I gotcha. Not even on a second screen, Lucas. Oh, come on. Okay, whatever. No, so I'm reading this in bed on Wall Street Bets, and I was like laughing hysterically, and my wife was not amused. She was having feeding time with the babies. She wasn't amused about it, and I even tried reading it to her, and she's like, okay, like whatever, because she didn't understand what I was saying. But it said, it was a guy texting his wife, and he said, honey, no matter what happens tomorrow with the consumer price inflation numbers, just know that I love you and I will always love you. Oh, I forgot that you're in Argentina. Only one. I got you. Not even secondhand. Well, I guess that's might be true. Man, it's because monitors have gotten so cheap. We get them secondhand, but they're probably harder to come by down there, huh? You just need to move up here. Need to get you family. Are you married? Maybe we can find you a girl up here. Just kidding. Just kidding. The University of Michigan consumer sentiment is now substantially lower than it was during the Great Financial Crisis. Really? Oh, by the way, back to 2009. So I'm super. I mean, like I could have made money there, right? I could have made another $20, but probably not another $20. Maybe only another 10 because it's coming back really hard, right? And I'm even starting to detect a little bit of like flight to safety in the treasuries. Like I think they're saying like inflation is bad, Federal Reserve is going to have to raise interest rates, but they're going to create a recession, right? Like really the strongest trade, let's not forget the whole thing that started at the beginning of this, right? Is that yield curve. Here, let me zoom out here for you a little bit so you can see it on the 210, right? But that yield curve like really got pummeled. That really got pummeled. So the yield curve flattening really strongly suggests a stagnationary spiral into deflation. Sorry, a stagflationary spiral into a recession. Sorry, is what I meant to say there. That's I think the strongest takeaway from the market action that we're getting here. And if that is true, which I think it is, I think that that's a pretty good takeaway from today. That means that, yes, you could see flight to safety bids in the treasuries at times. What a mess. What a way to end the week, too. Like, because the market was so quiet this week, waiting on this number, it did not disappoint. How many times have we had where we're really, like, it's market's dead, we're really waiting for a number like that, and then it's like nothing happens, we're like, okay, whatever. No, that time, they came through, didn't they? Maybe I should do charts though. I see a lot of scalpers, quote unquote, grabbing 200 points off of NQ off of them. Well, so it's an interesting thing, Lucas, right? Because a lot of what's going on, or let's say like the edge here, okay, is like when I'm watching the treasuries, I'm really paying attention to like how many orders does it take to make it tick up or down? Well, what are the inside bids and offers doing? Like, how aggressive are they? Like, if it ticks up, does that bid like immediately firm up? Does it take a little bit of time? Does it kind of go back and forth? How skittish is it, right? These are all kind of like a very qualitative feeling out just how strong that market actually is. And I personally find it very effective at telling me what the market's going to do. But I still have these charts over here and I look at things like the cumulative delta, right? So that I can come in and say, oh, well, there was like really strong buying in the 10-year at first, but then when they started to sell, they sold, right? That's useful stuff because sometimes you kind of get lost in the weeds when you're watching the DOM, right? So having a higher level view is useful sometimes, right? But now think about it with the NQ, right? The NQ moves around so much. These kinds of reads that I'm trying to make about like what's happening with the volume and stuff, like NQ trades so fast that it's really hard to get anything like that. You know what I mean? But so when an instrument like that, just kind of like the free movement of it per se, is kind of more of a thing because, you know, like if it's moving around and then all of a sudden it comes up to a spot and it pauses, right? And then maybe it goes through, then, you know, like, okay, there's probably an iceberg there, et cetera, et cetera, et cetera. So you could, if you were watching the chart, still pull that out. Although I still think that if I had a chart, it would need to be a chart with a cumulative delta attached to it, right? But on the same token, you know, most of these people that I see trading NQ, I see them making money, but I'm pretty sure that it's mostly, you know, excessive risk taking that's making the money for them. So, how high do you think that the treasury can get here now? Because that is like the high end of the range. Like if I really, really felt strongly that today was going to be a trend day where we close at the low of the day in the treasury, like 10's not a bad spot to take it. S&P 500 is not backing off though. Copper is getting slaughtered. Let's see here. What am I coming down through here? I don't have. Oh, I do have things right. So the instrument, that's really interesting. So the three things that I have at the top of my watch list right now, one is GE. So euro dollar is getting a lot of movement here is probably getting creamed. Next was silver. Seeing silver is getting hammered super hard. Oh, but they got hammered hard and now there's a bid. You cannot eliminate risk. Well, I don't know how I... Sorry, hold on. The tucking in my ear. 75 basis point hike now at 8% probability. I think that probability is higher than that, but I'm not too sure. Like for the meeting next week, I don't think they're going to do a 75 basis point hike. Maybe after that though. Maybe July. Maybe. Because they would want people to have warning, right? Wouldn't want to be just like all of a sudden, okay, we're going to raise rates. We're going to raise rate 75 basis points at a time. That would be a little crazy. So like, I don't know. The word eliminate risk, because in my opinion, you cannot eliminate risk, period. Right? You're not eliminating risk, you're only transferring it, right? And like when you come in here and you don't take a trade, that's not eliminating a risk, that's just not exposing yourself to the risk, right? So by not taking a trade, you do eliminate your risk exposure. Yes, you do. Can you eliminate risk through skill? No, you can reduce risk exposure through skill. But you can also reduce risk exposure by not taking it, right? So I think that's probably how I would explain it. I don't know. It's kind of a spitballing. I think you're kind of spitballing there, right? Like this seems like a rule of thumb, but it's always more complicated than we think, huh? It has nice wide rotations and much more of them than ES. Well, sure. Like, but doesn't that kind of say exactly like where's the money coming from, right? Is the money coming from like really having a solid predictive edge that really tells you what it's going to do? Or is the edge from you're taking on a lot of risk and that just happens to be the thing with the most noise, right? That's noise trading. Like in my opinion, noise trading is trading without really a solid predictive edge and relying largely on taking on excessive risk to generate profits. And you actually, as a noise trader, can make quite a bit from trading a range in the short run. But in the long run, those strategies are very, very prone to crashing, right? So that's where I'm always really cautious about the NQ, just because it's like, how are you actually generating an edge from that, though? Yeah, but one leads to learning and the other doesn't. But I don't. You know what though, Nasdaq Killer? As of late, I feel like I've been learning more from the trades that I decided not to take than I am learning from the ones that I did take. I've been doing my last like 10 trades or so have been pretty okay, right? But and in between there was a lot, and I mean a lot of trades that I didn't take. Some of them were good and some of them were bad. But I think that in the long run, it's like the ones that I didn't take that I could have made money on, it was like maybe, 10, 20 bucks at a time. And then I look at the ones that I didn't take that I shouldn't have. And those would have been like absolutely dismal, terrible trades, NASDAQ is the boss of everything. Okay. NASDAQ it is kind of been interesting to watch how, especially after the pandemic, how much more dominant the NASDAQ started to become, isn't it? You can profitably trade the chop as long as you're aware that sooner or later it's going to go against you, and that tail risk should be controlled. You want to take advantage as much as possible of the chop before it fails and adjust for that risk. Okay, so I think that when we're talking about this, to really kind of do like a useful statistical discussion of it per se, you have to think of it in terms of daily returns and not individual returns, right? Because we want to sit and say, okay, here's a distribution, and this distribution is all of my trades, all my individual trades. But that doesn't really work, because especially if you're using set targets, then really what your distribution looks like is this, there's my target and there's my stop, right? And the difference between these two is how much I actually make, right? Okay, so what we really need to look at is daily returns. And what I think that generally people are doing is this, is like, if this is the zero line, they're taking a tiny profit. And so most of their wins are going to be like this. They're not necessarily letting them run. Okay. And then you've got this huge tail like this, right? On daily losses. So now this tail might trail off more quickly than that. It might be like this. But the issue is that if you keep trading, there's going to be tails. Now, you can come and you can like try and cut the tail off by giving yourself a daily loss limit, right? I'm not going to lose more than 1%, right? But when you do that, what you're really doing is you're saying you're taking all of these and you're moving them, right? So really you're taking all of these and you're just moving them here, so that now your distribution looks like this, right? So it doesn't necessarily actually make you money in the long run, just from straight up doing that, right? And the issue is, okay, it's not that it doesn't work or that can never work. The issue is that the amount of data that you need to be able to tell that it works is higher than we have, essentially. So you get all of these retail traders that think that it works, and then all of a sudden find out all at once that it doesn't. And then when it doesn't work, they blame themselves. So they still think that it works and keep trying it. That's why I'm so skeptical of it, right? Like the thing that I need to see for me to want to try and trade like that is full complete 5-year track record, for instance, or like real empirical data that really says that like what you're catching out of, this particular situation really does have a set probability of you getting, making money. So like we have a really good situation to try and take a trade like that in our liquidity holes scenario, right? Liquidity hole scenario, latent liquidity isn't very good. We're going to be stuck in a range. You could try and take fills just on the right in towards the middle of that range, and as long as it's more than 1 or 2 ticks in ZN, you could go and pull that out quite a bit. It might be hard to do in ZN because, again, I think you need more than just it sitting between two prices, right? Possible setup, right? But I would need more than that for me to say that it's worth taking as a trade. Because as I do it right now, all it just tells me is, well, unless I want to sit in the trade for another 45 minutes, I should get out. Is the way that I use it. And to time things. I look for setups and returns, and that setup needs to be adjusted based on volatility. Yeah, I don't. So that one is I haven't figured out, Lucas. I always thought that it was just as simple as, okay, like here we have a strategy, and then, oh yeah, we need to adjust what my target is based on the current volatility. So I'll say, use a percentage of the average daily range and use that for your targets and stuff like that, right? And what I always found was that the volatility changes too quickly for that to work. Like it didn't actually provide an edge because the volatility changed too quickly. I think that discretionarily that maybe you can do that, and that might work, because discretionarily maybe you can predict future volatility, right? When you say 5 years of track record, is like that you saying that because a marathon runner won gold 5 years in a row, that he will win for the 6th year? Not necessarily. But what it means is that if this guy won gold 5 years in a row, then maybe his training methods are worth considering. That him winning 5 years in a row is a pretty solid indicator that I might want to try his training methods, right? Not that he's going to win next time. Doesn't mean that you using his training methods are going, but it does mean that it might not be a bad thing to study him and see what he's doing, right? But what people do is they come in and say, I made money this year. You should come and buy my course, right? When you doesn't tell you anything. Especially if you don't have the full stats in front of you, which nobody ever gives. So, and I point that out all the time so much because I think that a lot of people get drawn in by that and get suckered by that. They say, oh, this guy made like $10,000, or this guy made like $1 million last year, so obviously he knows what he's doing and I should follow him. So they start following him, then they don't get anything out of it. Doesn't work for them. And it doesn't make sense to them. Why? I don't understand. This guy was profitable. How come it's not profitable for me? Right? And what they don't understand is that the range of randomness in trading is huge. It's huge. And it really does require like this massive data set to come in and say that like what this person is doing really truly is a strategy that works well on this market and is likely to continue to work well on the market. And at least enough for you to want to try and utilize it. Do you know of a tool or software that can calculate how much the market will move when I buy or sell a large amount of contracts at once? At once? Okay, not for retail traders. But I do believe that Ready has some tools that are kind of like, okay, if I want to take out all of the orders currently on the book up to here, how many contracts would it be? Okay, I'm okay with that. Let's do it. And then it will execute the sweep for you. Because apparently, get this, I don't remember where I saw this. Maybe it was on the subreddit, but it was they were directly referencing the documentation from the CME. So it seems that this is accurate, but it was a huge surprise to me. Okay, is if you come in right now, the offer is like, there. The offer is like 250 contracts right now. So if I came in and bought 3,000 contracts, it would not fill 250 of those and then fill 1,500 of those and then fill whatever is left at the next price. It basically, if you put in one big limit order, it will only fill the contracts at that price. Or was it a limit order or was it a market order? Oh, it should go back on there. But so it kind of suggested to me that these situations where you see the S&P 500 and moves like multiple ticks all at once, that those are in fact are either like a stop run, like multiple people, creating a cascade, or a robot that explicitly says, sell this price, sell this price, sell this price. I think I found an edge. The correlation between treasuries, if ZN and ZB are at their highs or lows and are going to break, and UB is the lagger at 4 or 5 ticks behind, I can enter UB. Okay, so why would you think that? Well, okay, so like if we were to say today, of course I don't have it up, but let's say that I don't have UB up, but let pretend that ES here is ZB, right? Let's say that ZN and ZB are at their lows and they look like they're going to break lower, and UB is a little bit higher, right? So why do you think that is? It's the spread, right? The spread this way means it's a flattener. So you will see the situation where this one drags this one down, and you might even, in this one, you might even see buying volume. Like it might even be trying to push up, right? So the key on that one is you just kind of got to know where the complex is heading in general and kind of ignore the difference in the spread and say, well, I still want to sell this instrument. Okay. But there is kind of a problem with that, right? This one's not going to move down as far because of that. You're not going to get paid as much in this as doing it in this one than in this one. That's why there's not as many people playing it like that, right? But it could be the other way. Okay. And that could change very quickly too. So let's say that we're getting a risk off move, right? So now the 10 and the 30 are at their highs. What are you going to see? You're actually going to see that UB already traded its highs, because it's still going to be a flattener in that situation. They're still going to be predicting stagflation into a recession and playing a flatter curve, even though there's like flight to safety risk or flight to safety bid in the treasuries, essentially, right? So that would be a situation where like it wouldn't really work. So I'm suggesting that the pattern that you think you are seeing is something that would seem very, very consistent in the last month of trading. But when you look at different market environments, it's not going to act like that. It's not going to act like that in different environments. You're going to get these situations where this one's going to break first. Or if we go into a different, where we're in a steepening environment, right? Or in a steepening environment and we're moving higher, like you could get this one where these break and then turn over and this one doesn't go. This one actually drags them down. That can happen as well. So again, how much, like the question you should be asking yourself is like, what is the level of where's the bar? Yeah, that's the word that I'm looking for. The question you should be asking yourself is like, where's the bar in terms of like proof for me to want to trade it, right? Could I write this up in a paper and submit it to the Journal of Futures Trading and get published, right? With the data that you have. Well, if you have 5 to 10 years, maybe. Yeah, 5 to 10 years, maybe you could, especially if you have some sort of mathematical model to explain how it works. Yeah. But I'm going to guess that you just looked at the last month, because I know that it doesn't always behave that way. Well, you know what? When they were all the way up there at 10, I was kind of like, well, Remember I said that if you think this is going to be a trend day, this is where you should sell it. They went a little bit further. I think they went up to 12, but now are they going to punch lower now? Real possibility. It's been long enough. It's been long enough that I think you could see another leg lower, yeah. UB has a lot of volatility. That's true too. That's true too. I mean, you get this for almost anything though, is like there's a lot of correlations between things, and like you can do these situations where the two things are correlated and one's lagging, you can buy the lagging one, and right? But it's just that might be a start for a strategy. That one, if there's like a really strong correlation, but it's a little more complicated than that because it could be lagging for a very good reason, right? If you can come in now here's another side of it though, is like if you can come in and you can explain based on the informational content of the market why that particular one is lagging and why the move will probably continue to trend in that direction, and you can make money off of it lagging, then that's maybe then you have a good trade, right? And I mean, that's essentially what we did today. Was we were coming and said, well, you probably can still sell treasuries because the only reason they're going up is because of spreads. I think you really need to understand the spread trading to do it effectively. Maybe. I really wonder, like, I really need to do better statistical analysis of the spreads, basically. It's kind of difficult, but I think that there are a couple of limited things I can do with the spread, because I do kind of wonder. You're developing an RSS feed with Python. That's good. Is there a certain RSS sources you found that were really useful? Because I've always had a hard time finding those for futures trading purposes. Hey, Seven, I haven't seen you in a while. How's it going? Sounds like Donald Trump is going on a tirade on Truth Social about these inflation numbers. Let's try doing a quick little study here. I just had an idea of something that I think we can do. So I think that I can come in here and I can do the 10-year. And I'm gonna do this in 30-minute time periods. Shall we say? No, let's do it in 15-minute time periods. 15-minute time periods. Okay. Okay, so here it is. And then what I'm going to do is I'm going to go in and I'm going to add an indicator. Then I'm going to add my range. So here's my stats. Range histogram. But the input series will not be ZN. The input series will be... I don't know if this will actually work. This isn't going to work. It's going to fail. Well, let's try it anyways. Spread candles, front leg, ZN, ZB. It should be 5 to 2, right? Yeah, 5 to 2. 5 to 2. Okay. Okay. Oh, it totally worked. What the hell? Hmm. Oh, no. So now what I need to do is I need a lot more data, right? Instead of 5 days, to 1,000 days. Well, when it comes to macro news, I think RSS feed doing good. Well, but like, what specific URL or feed are you using? Because like the issue that I've always found is like, oh, there's like stuff on Twitter, but like RSS feeds are kind of like not as popular anymore. Okay. Well, I'm gonna say that's not too helpful. So there are some significant drop-offs here, right? Let's come in here. Let's do this by area. No, that didn't change too much. If you use it by log, you can see how much kurtosis there really is in this distribution, right? Well, okay. So like if you're just coming in and you're saying, okay, like how do you do RSS feeds in Python? That's fun and everything, but like there's going to be a URL that you're going to be calling up, right? That you're going to be getting your RSS feed items from. What URLs are you going to use? Because I have had a really hard time finding good feeds to use for sources. Okay. So basically what we have is we have a distribution that seems to follow a log rule. Exponential distribution with the range of yields. So that does kind of suggest that there might be some places wherein when yields tries to go outside of a certain range, maybe you would have a pretty good probability of fading it. But when it busts out of those ranges, those are worth a lot more. But the area here that is blue is much smaller than it is in the ES, which suggests that there's actually a higher kurtosis. It's still following a log rule, but the exponent on it is in ES is more like this. Anyone have an econ calendar that you can skim high impact events programmatically? I don't need the data, just the events. I've had a hard time finding that too. I would really like Financial Juice to start providing that, because I would like to plug it into NinjaTrader and utilize that in my back testing so that when there's a major news event like that, it just stays out of the market, right? Yeah, just put like spaces around the .com, or don't put the .com part on it so that YouTube doesn't think it's a URL. So this is interesting. It does kind of confirm something that I've thought about spreads, which is that there is a higher kurtosis involved in them. But I don't know if that's like actually a profitable trade. Wow, so 1.54. Jeez. You know what happened was they came back and they said, hey, Seth, like, we're being nice to you. We would like you, you want to get in on this train so that you can make another $30, $40. Like, let's do it. And I was just like, I was done. Well, you think it goes further than that now? I guess 117 should be on the table, right? 117 definitely looks like that's a possibility. We could come into the like a daily ZN chart now at this point. And right? So when we get now we're getting to like yield prices from like 2019, right? Oh no, actually we're even below that now. So I'd have to go even further back. Will it let me go further back? 3,000 days. Will it let me go? Oh, yes, it does. Oh, yes, it does. But even then, curious. Drawing tools, snap mode, bar and price. Drawing tools, labeled array. Oh, that's not what I wanted. I wanted to label the line. Oh, labeled horizontal line. There you go. Yeah, we're well below that. Like, from a technical analysis perspective, like, how can you say anything other than there's like key support here? But if we're thinking they're going to go to 3.5, like, that's all useless, right? Where it's going to stop and so forth doesn't tell us anything about it. No, you missed a good trade because you forgot about the 30-year auction yesterday. Well, that's why when you have financial juice, it will kind of warn you. Also, when you have the Jigsaw Journalytics and you're paying for that, there is a screen you can pull up that will show you breaking news, and it will make a sound before that news happens. So that's how you solve that problem. The thing that I'm trying to solve is, if I'm trying to trade a technical analysis kind of a strategy, any kind of a move from news, from planned news, should probably just be avoided. Oh, you have news squawks, so then why didn't you have the news squawk on? They didn't tell you about it? Man, Mr. Bond, you're a high roller. I didn't know. You just don't listen to it all day. I get you. I'm super jealous. I want news squawk. Dang it, man. They're so good. Especially on things like the auctions, and like they'll warn you about block trades, and like they give you good stuff on bonds that I never heard anywhere else. Kind of that one or 2 weeks when I had it was like, it's kind of nice. I got emailed by a sales guy from them the other day. I was like, well, I already use this other thing, but like, I'd love to help you out. He didn't respond back. So sad. I was a little disappointed. So I would love to. I love at least chatting with people like that. Man, well, I don't know. I don't know what to make of this here. Like, so the 10-year looks like it's ready to go a little bit lower, but the 30-year is not coming with it, right? Because so you're still having like a extreme amount of flattening. But so if I were to take a trade over here in yield futures, I don't know if I would really get paid. Like if I could take 15 to 16 here, for instance. Plus, probably. Oh, actually, no. They came to get him. Okay, never mind. The kids got to go here in a little bit, but I thought that maybe we would be driving them, and that's not. He came and got them. So. America's doomed. So let's go and read what Trump was saying. There it goes. A little bit lower. I don't know. I made $20, but should have made like 50, 60, 70. Oh, I don't know where we're going. Ivanka Trump was not involved in looking at or studying election results. She had long since checked out and was, in my opinion, only trying to be respectful to Bill Barr and his position as Attorney General. In parentheses, he sucked, says Donald Trump. Okay. The inflation numbers are catastrophic, quoting Art Laffer. Lower than it should be. I told you, should never have happened. I never said hang Mike Pence. Political witch hunt. Well, I didn't actually say anything all that interesting. Zimbabwe. Okay. I could be down with that. Now, aren't they getting investment from China? Are they getting investment from China? I need to sit up straight, man. I'm gonna have a bad back when I'm older. See, it was a good idea not to try and take that one. Man, coming back and looking at it though, if I had taken that initial trade up here when it was like at 10 or 11, that was just a really solid trend. I think that the difficult thing that we would have had with that one would have been like, once it broke, how much further would it go? Because it is like we did just get like 2 pullbacks that were pretty deep from that. Oh no, the baby, he is sad to see the other kids go. He's had them for like a week and a half now, and now it's all by himself. Just him and the infant. And mom. Mom has to pay attention to the infant. Nobody to hold the infant for him. Maybe she'll put him in the infant basket swinger thingy. The FOMO is so real right now, guys. I'm not going to take a trade 5 minutes before I'm probably about to quit. And yeah, I probably should. I'm going to record a video today. Think I'm going to do it? I need to clean up a little bit though. I was testing this new piece of hardware, and I did a bunch of different things and had some weird behavior with it, and everything's a mess because I got stuff all over the place dealing with that. So I need to clean up. I need to clean up first thing. I probably could record today. If not tonight, maybe I wait until the baby is asleep. Because otherwise my wife is going to have a hard time with both of them today. So maybe I should wait till tonight. Maybe I should wait until he's asleep. Or maybe not even until he's asleep. Maybe I should do it tomorrow morning before they wake up. China's the new king. Oh, I get what you're saying now. The whole China investment in Africa thing is like really interesting. I don't know what that means for the future and how that turns out, but it is a really curious thing that they're doing there, right? Okay, so they tagged 117. We're getting another pullback. I gotta say, like, what do you guys think? Oh, by the way, did we close our poll for Bitcoin? Oh, you got 28 votes. But the vast majority of you think 20K. How low do you think the 10-year will get today? We should have pulled that earlier. Well, it's a crazy move. You know what's always fun on a day like this is to scroll up on your DOM. Oh man. Okay. There was 118. Yeah, they basically said they want Africa to be its China. Yeah, but like, will that actually work? Like, I don't know. And what happens if it works? Because like, here's the thing. So do you come back into this world? It's like China dominates the world for like 20 years. And then the time of Africa comes. That would be, I mean, I don't want to say anything that makes it seem like it's unlikely or like that it's crazy that would happen, but that would certainly be an unexpected turn of events given the history, right? But there's a lot of natural resources in Africa, and it's a big continent. Wow, they don't necessarily have to unite, do they? They just need to get their economies developed. Stop taking the handouts. I'm telling you, that's one of the biggest problems. Yeah, youngest as well. That's true. I mean, now that it's tagged 117, now I'm definitely not going to take a trade. If it came back to 09, if it came back to 10, sure, maybe worth taking a short, but I really should have taken that short at 10. But I kind of said like, it is, but I'm not going to take a trade. That was a missed opportunity that I really kind of dismissed, even though I should have known better. But I guess I had already checked out. You know what? It's probably not. It's probably for the best for me to not like to ease myself into it. Like, this is a lot of risk today. I caught one good winner. Didn't trade the rest of the week. It's probably best that I just kind of take it easy. You know, I should take some trades because I do want to pay for the data fees this month. So there's half of it, right? Probably got like another $40 that I'd like to make this month, but I bet you we'll probably have plenty of opportunity next week. This is kind of move like I was kind of gaming it out earlier, right? When we come over here into the ZN, let's do it from a volume profile, right? I do not think, personally, that this is one where it's like tomorrow it goes, yep, and it retraces this whole thing or something like that. No. This is one where like it goes down that day, and then maybe they come to here, right? Like, high possibility of follow through. It makes you wonder on this move here. There was some real buying, right? There was some real buying through this. Are there any of these guys left? I mean, we've broken it up. Are there any of these guys left, or is everybody short again? Well, we won't know until next week when we get the COT numbers, right? It'll be curious. Also, 30-year coming back quite a bit more aggressively. So, still having difficulty getting paid for any trades in the micro 10. I don't know though. I'm still like coming back and thinking it was only 0.1. It was only 0.1% higher. Is that really the end of the world? It just makes me more interested in what next month's CPI is going to be. But like, this is the problem, is that like clearly my impression of the number is not the same as the rest of the market's impression of the number. Like, everybody else in the market is like, their hair is on fire right now, right? They're like, this is the worst thing to ever happen in financial markets ever. And when it's like that, it's usually not a good idea to fight them, right? To be looking for that pullback, you usually not a good idea. Like, usually you want to like wait until everybody is short and they've all kind of forgot that things can even move up, and then try and take that one, you know. Man, this is you know what? There's something that gives me a little bit of hope, though. Should I say hope? I don't. How do I put this? This is good for my portfolio. Okay, the gold and silver have been just dismal for such a long time. Absolutely dismal. And today, gold and silver finally acted as the inflation hedge that they're supposed to be. Maybe this is the beginning of it decoupling. Maybe this is the point at which the gold and silver decouples from yields. That would be awfully nice. Also, you know what we should check here? How are the banks doing? Let's pull it up on TradingView and look at the XLF. Okay, so XLF, financial sector fund. Ugh. Not good. No, that's not good. That really sucks that like your banks are finally getting the higher yields and they're just getting creamed. Like when we were over here, owning banks sure seemed awfully smart. This is not good. Wait. So let's compare it. We can compare. Compare it to ES futures. Same percentage scale. Okay. Okay, the top one is XLF. Okay, so let's come back to like 5 minutes, maybe. It actually looks like, since yesterday at least, that the banks are only mostly following, if not a little bit better than the S&P 500. Is the S&P 500 really down 5%? Wait, where is this? 2.73. Oh, wait, where am I getting down? Oh, that's like the whole chart. Okay, yeah. Down 5% on the week, maybe, yeah. Okay. Gold this year is up? Well, it's not. Technically not, but my that's not where I'm in from. Right? Here's gold. Right? Remember this? Yeah. It's been a tough ride in gold and silver, okay? It's been a tough ride in gold and silver. Were they back at 1820 like at the beginning of the year? Maybe they were. I don't have a daily chart for them open over here. I don't think I'm going to bother opening one up for them. But no, like so like the point is this, Mr. Bond. If you came in here 6 months ago and you said, "Oh, I want to buy a lot of gold because I think that inflation is not going to be transitory," you didn't necessarily make much money from it. In fact, you probably lost money because I did that. I got into gold, silver, like back in, oh, when was it? Oh, actually, I think I've been in it for almost a year because I think I did it a little bit after the GameStop mess. Yeah. So since then, hasn't been good. Hasn't been good at all. It's actually a huge loser of a position for me. Shall we go and look at the damage? I won't show them on screen, but I'll tell you what they are. Well, if there's anything interesting, let's say, because I don't necessarily want to like reveal my whole portfolio, right? But I bet it really sucks. I bet it's just going to ruin my whole weekend just even looking at it, but I'm going to look at it. Let's do it. I'm a masochist like that. At this point, not losing huge amounts of money is winning. I'm having a hard time seeing where, like, I don't know, like when we had the early February, March decline, I was like long oil. And so I wasn't long oil when like the Ukraine thing happened. I was like a month or two off. But, you know, that basically hedged me and was really well, right? But this more recent decline, I think it could probably be said that I lost a little bit less than the overall market, but like it's so trivial of a difference. It doesn't take away the pain. You know what I mean? And like I come back and I look at some of these and I'm like, well, I like what I got, but I like what I got, but I don't think that you can just automatically assume that these are all going to come back. You know, it might be better to dump some of these positions and, well, okay, so I'm 5'7", so that's not too terrible. Oh my gosh, the daily loss is so bad though. That's probably one of my worst daily losses. So the silver is not actually I only made $9 on the silver. Oh my gosh, dude. So in my silver position, I'm down like 48% on that one. And then I have a tech that's down almost 70%. Like that one, I thought, okay, like we're down. That's bad. Could have been worse. I could have bought Zillow at the top. He'd be down like 95% or something like that, right? Oh man. Oh, hey, I'm actually. Oh no, that one's down too. So where's the majority of that? Well, okay, so Goldman. Oh my gosh. Yeah, my bank, that's actually not good. So my bank is down almost 5%, whereas the S&P 500 is down 2.63%. So my holding a bank is hurting me here. I think you invest in gold thinking, yeah, but I lost 40. Like, you know what I mean? Like this has been the thing about this market, that I think is, oh, my camera die here. That is really, let's say, frustrating. Let's just call it frustrating. Is that like, if you were in the place to have been was corn and oil, right? If you were in corn and oil, then you probably did okay. I picked a bad price, I guess. So I come in, I'm getting in at a time when concerns about inflation were kind of dying down, right? So you'd think that we're getting a good price on silver, and no, like I got an absolutely terrible price, and it's been down big ever since then. Right now, it's not leveraged. It's just First Majestic Silver. So, right, you might have the right idea, you might have the right theory, but the asset class that you chose to play it just doesn't perform, right? And this continues to be a thing. So you sit back and you think, so is now like gold and silver finally going to perform? Well, we saw a real decoupling today. So maybe because we saw a real decoupling today. But well, they're not a miner, they're a physical silver trust of my understanding. So anyways, the thing that's really hurting my portfolio today, though, is the bank, right? So here again, you're like, oh, okay, so if we're going to get higher interest rates, you want to be in banks? Nope. Well, because the spreads flattened. And today they flattened a lot. And they're still stocks, so they still get hit with, everything else. So that one did not work out. How do you play higher interest rates other than going long interest rates? Doesn't seem like there is a way to make money on that one. To hedge yourself on that one. No, the play was corn and oil. Probably the play is still corn and oil. Should we be long oil? Should I be going and buying USO? Yeah, well, I'm not gonna. We're just gonna try and relax. We'll go back to my portfolio there. Maybe it goes back to being worth $5,000. It's okay. Or gotta do that one for the long run. And we're gonna have to put more money into it. Although right now I'm focusing on putting the money into my IRA. So building it up pretty good with the IRA. Even though it's, keeps going down. What a day. You think this keeps going, or do you think that they're gonna stabilize at 117? I'm gonna be really interesting to see where the treasury ends up at today. But I think it's gonna be even more interesting what they do on Monday. I kind of suspect that they're gonna come out of the gate and they're gonna try and sell it even harder. But because I really do think that next stop in the 10-year 3.5 probably. Yeah, my face is frozen. I guess I didn't get enough charge on my camera yesterday, so. I was thinking I need to do a video, right? But I'm gonna have to charge the camera, so I'm not necessarily doing it first thing here this morning. But we are gonna go and probably hold the baby. Probably. All right, guys. Try and have a good weekend. So next week might be pretty nasty. In the meantime, stay profitable, friends, or at least don't lose it all. Or at least don't panic too bad, because this is an ugly market.